Welcome to this video on the long calendar spread strategy. In this video, you will understand what the long calendar spread strategy is and how you can set it up. We'll do a short comparison of the long calendar spread and long straddle. You'll also understand the impact of Vega and when to deploy the strategy. You can create a long calendar spread strategy. Basically, to construct this strategy, what we're doing is buying and selling the same type of option for the same underlying and the same strike price, but at different expiration dates. So, you are buying a far-term option and selling a near-term option. Let us see the difference in the objective between a long straddle and a long calendar spread. In a long straddle, we want to take advantage of the fluctuation of the underlying price, basically caused by volatility. And in a long calendar spread, we want to take advantage of the difference in volatility over time. Additionally, a long calendar spread offers a natural hedge, unlike a long straddle, because we are both buying and selling options. Before we get to the part where we try to understand the impact of volatility on this strategy, let us first look at the impact of Vega. Vega measures an option's sensitivity to implied volatility. In a long calendar spread, we are taking different expiries, so let's look at what Vega looks like at different expiries. As you can see, as the days to expiration increase, Vega also increases. The near-dated option has lower Vega as compared to the far-dated one. Since Vega is higher for far-dated options, it means that these options are more sensitive to changes in IV. To explain further, we have two positions, and now we will see how both of these positions are impacted by Vega, which is the option sensitivity to IV. The option that we bought, which is the farther-dated one, has a higher Vega compared to the one that we sold. This means the farther-dated options are more sensitive to changes in IV. The reason is simple: longer-term options have more time to be affected by potential volatility. Now let's take an example. Let's say we created a long calendar spread strategy, where everything is the same, but only the expiry is different. We are buying the far-dated option for $5 and selling the nearer-dated option for $2. Let's look at what happens when IV changes. In the first scenario, when there's an increase in IV, the premium also increases. The impact here is positive because we bought this option, and it is negative here because we sold this option. But since Vega is greater for the farther-dated one, the increase in premium will be higher. For example, if the Vega of the far-dated option is 0.25 and the Vega of the near-dated option is 0.15, an IV increase of 10% will increase the far-dated option premium from $5 to $7.5 and the near-dated option premium from $2 to $3.5. Initially, the spread, which is the gap between the premiums, was 3, but now the spread has widened to 4, increasing the profit potential. Overall, we are gaining from this strategy when IV increases. In the second scenario, there's a decline in IV, which results in a decline in the premium. This has a negative impact on the option that we bought, and a positive impact on the option that we sold. But again, it's greater for the far-dated option. If the Vega of the far-dated option is 0.25 and the Vega of the near-dated option is 0.15, an IV decrease of 10% will decrease the far-dated option premium from 5 to 2.5 and the near-dated option premium from 2 to 0.5. Earlier, the spread, which was 3, is now 2, so we are losing from this strategy. To understand the third scenario, you need to know the impact of theta on a long calendar spread. Near-term options will generally have a higher sensitivity to theta compared to longer-term options, and secondly, short positions have a positive impact from theta. The option that we sold is losing value faster than the option that we bought, so overall, it has a positive impact on the long calendar strategy. What happens when the IV is stable? The spread is not impacted by volatility, but both options experience time decay. Let's say over 5 days, if the volatility remains stable, the theta per day for the near-dated option is minus 0.05, and for the far-dated option is minus 0.02. The near-dated option might decay from $2 to 1.75, and the far-dated option might decay from $5 to 4.9. Therefore, the net impact would be a slight increase in the spread. This tells us that theta by itself does not have a very significant impact on the strategy, it is mostly about the volatility. Besides theta, other Greeks like delta may also affect the long calendar spread. But again, it wouldn't be too significant. For example, if the delta of the far-dated option is 0.6 and the near-dated option is 0.5, a $1 increase in the underlying price would increase the far-dated option premium by 60 cents and the near-dated option premium by 50 cents. The overall impact on the spread is minimal. In this strategy, we are essentially exploiting the volatility by taking a relative view of two options contracts at two different expirations. When should we deploy it? Since our strategy benefits from an increase in volatility over time. If you know that a big event like the FOMC meeting is coming up and you expect volatility to spike in future, it would be a good time to deploy a long calendar spread. That is all for this video.